And basically, I'll just quickly get started. I think there was some audio issue. So this is Shardul Dabir, the innovation specialist with the GFI India team, and we are here today for webinar number 18, as you all know. And the webinar is focused on building successful consumer brands for the smart protein sector in India. It's an interactive webinar, and in the last 10 minutes, we'll also take live Q&A. But we already have some questions from the registration form, and it will be a series of questions moderated by Varun with Hari. And the session will last for an hour. A lot of you who have joined this call for the first time, this is a community of 500 plus stakeholders from India and Asia Pacific region, and also a few stakeholders from the global ecosystem of the alternative protein innovation. And in India, we are building the smart protein ecosystem with the help of entrepreneurs, investors, stakeholders from the corporation. We've been putting together this community for almost 2-3 years now. And now that we have about 500 people in our community, we have shifted to a different mode of communication. So all of you must have received our first community update mailer yesterday as well. I've resent it to you, a lot of you today, but please ensure that you mark it as safe so that you're getting these timely updates on a regular basis. We have few interesting sessions lined up tomorrow and day after as well. So without further ado, I would actually quickly introduce Hari, though a lot of you have already seen, what Hari is all about and what he's been doing. He leads the India Investment Advisory team at DSG Consumer Partners, and he has more than 8 years experience in private equity and investment banking. Before DSG Consumer Partners, he spent 4 years as Vice President at Peepul Capital Investment Advisors, a growth capital private equity fund that managed more than $700 million under assets. Prior to that, Hari also worked with Veda Corporate Advisors, Rothschild Private Equity, and Accenture Management Consulting. He has an MBA from IIM Bangalore and has a B.Tech in IT and Manufacturing Engineering from College of Engineering Guindy, where he was a University Gold Medalist as well. It's a pleasure to have Hari today because DSG, as a lot of you might know, has been investing a lot in CPG brands and building them from a long-term perspective. Epigamia, Sleepy Owl Coffee, Veeba, Chai Point, Pressery are just some of the examples of CPG brands that they've helped build and scale. And we are really glad to have Hari today with us. So welcome, Hari.
Thanks for that, Shadu.
Great. And as you all know, Varun Deshpande is the Managing Director for GFI India, and he'll be moderating today's session. So Varun, on to you.
Thank you, Shardul. Excited to have everyone here. Thank you, Hari. Thank you so much for your time. I'm very excited to have this chat. Since we first chatted a couple of months ago, I've been excited to have you on the GF Ideas India webinar series.
Thanks for that, Varun. Look forward to it.
Yeah, of course. I'm gonna dive right into it, Hari, because we don't have a lot of time for all the excitement that we want to pack into this session, right? So, as Shardul mentioned, DSG Consumer Partners is one of the biggest names globally, not just in India or Southeast Asia, in investing in creating great consumer brands. So we're going to focus in this session on thinking through some specifics on building a brand, as well as on business strategy, on channel strategy, on how to talk to investors, what investors want to look at from entrepreneurs as well. So Hari, you have the broad context of the alternative protein or the smart protein sector in India.
Right.
It's very much still in its infancy. Excitingly enough, we're seeing a couple of market launches, as you and I have discussed over the last few weeks. And entrepreneurs are thinking about building a brand in many different ways in this space. Now, you at DSG have helped build brands across the world, and particularly in India, you've made investments in companies like Epigamia and Pressery, which are quite relevant here, right, in the CPG or the FMCG space, as we say in India. So, a quick general question: what would you say are the most important pieces of advice to entrepreneurs looking to build a consumer CPG brand?
Got it. So, thanks again, Varun and Shardul, for the introduction. Really happy to be here. So, I think maybe it would make sense to just cover the reason for existence for a consumer-focused VC fund like DSG. I think if we start there, that should sort of set the context. So, DSG was started back in 2013 as the first consumer-focused brand in consumer-focused venture capital firm in India and Southeast Asia. And the reason for existence for an exclusively consumer-focused VC firm was mainly two, and that's like foundational to how we think about investing, business building, all of that. So the first thing is that we believe that strong brands take time to build, and it is very contradictory to the typical VC preference for blitzscaling businesses, etc., which is possible in tech. However, we genuinely believe that brands take time to build, and founders should have that flexibility and leeway to not be super aggressive with respect to growth targets, etc. Now, the second thing is, obviously at the end of the day, we are a venture capital firm, and we will be looking to make our returns. So the only way you can still make the returns despite growing at a reasonable pace and much slower than the tech businesses is by being capital efficient. And that is something that we encourage our entrepreneurs to start paying attention to from get-go. Because if you get to the same scale that a tech business would, even 4 or 5 years later, however, in the process, if you consume a third or fourth of the capital in your journey, the returns add up for all stakeholders, for the founder, for the investors, and everyone. So that really is our philosophy. As with everything else, there's no one playbook for building a business, but our preferred playbook is where we expect or we prefer our businesses to focus on fundamentals, both business and brand from day one, and just build it in a very capital efficient manner and with as little external capital as they can. So, if anything, I think that sort of would translate to what my recommendation would be for consumer entrepreneurs as well. It's better that they take their time to figure out who the core customer segment is, figure out what sort of positioning and brand narrative they want to build around the brand. And then, once you have some handle on these two aspects, then look at scaling. And even there, I would urge them to look at scaling with very realistic growth expectations and just not get carried away by pressures that typically come with equity infusions, etc. So yeah, if anything, I think that would be my two suggestions. Just focus on fundamentals, both business and brand, and not pursue unrealistic growth targets, because that is like a billion or bust game, which we don't think has to be the case in consumer brands, because you have a physical product and you can drive to a meaningful outcome if you take a very calibrated approach.
Okay, Hari, actually, as you were saying that, and that's very astute, I had a couple of really, really basic questions that I think even I would benefit from your, say, explaining them in your own words, right? Of how you would look at them. Firstly, what is a brand? What are the components that comprise a brand? I guess, especially in the space of food, packaged goods, etc. What are the things that comprise a brand? How do they manifest in the consumer's mind? What are those things, those components of a brand?
Right. To us, especially, it holds true always. For us, the brand is essentially the, what we call the positioning in the minds of the customer. If you think of any of the iconic brands, the moment you think of the brand, there is something that immediately pops up in your head. And it just finally boils down to nailing down what that positioning statement is. And I'll come to what I mean by positioning, etc. And if you are the first brand that that gets to that positioning in the minds of the customer, the leverage that you have in the long term is just manifold. And often it's something that that founders do not pay enough focus to, because it's very intangible and fuzzy, and and everyone has their own perspective, etc., in terms of how they want the brand to stand for. It ultimately just boils down to what we call outside in thinking, and that's something that we encourage all our founders to pursue, throughout the journey of the business. It's essentially wearing the customer's hat and coming at it from the customer standpoint on what does your product stand for. And, just double clicking on the positioning statement, it just boils down to who's the core customer segment that you're going after, and then what is the need or pain point that your product solves for. And, and on who's your core customer segment, the usual, things that we've heard is, very, 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 more the cliched stuff like, demographics-based segmentation, gender-based segmentation, mass premium, etc. But there is some nuancing to that. I think a brand is really powerful if you're able to segment your customers by interest and motivation as opposed to these things, right? So just to give you an example, just so that you can appreciate it a lot better. In our portfolio, we have a brand called Nutrova, which is in the supplement segment, right? And as you know, it is a segment that's seeing a lot of clutter, a lot of new brands, coming at it from, there are brands that are positioned as plant-based alternatives. There are brands positioned as Ayurvedic supplement brands, sports nutrition brands, etc., etc. So now, if you look at the positioning that Nutrova is driving towards, it is all about evidence-based nutrition. So every product that they launch will have a clinical study done on the final product, on the efficacy, etc. So what that means from a customer standpoint is that it is essentially for customers that are not going to go buy a brand because an influencer asked you to, or even if it's a friend that recommends it, etc. This is for customers that like to make their own independent decision, looking at the data from clinical studies and just doing that, that putting in that extra effort to research and then finally deciding on purchasing from Nutrova, right? So that's what I mean when I talk about interest-based segmentation. So other than just going with age, income profile, etc., it's important to really appreciate things from a customer standpoint, the pain points that they have, and how do they go about, making the purchase decision, etc. When you segment it in that fashion, you would be able to, identify a positioning statement that your brand can stand for over the long term. So, Nutrova's ambition is to be, the preferred clinical-based nutrition brand, and just occupy that positioning. If they do a good job, there's no one that's focused on that. There are players playing on clean ingredients, plant positioning, etc. But this is like a nice, unique positioning statement that actually can resonate well with the customers as well. So, if anything, when it comes to brand, to us, it's all about positioning. And if you're able to be the first brand that takes up that positioning in the minds of the customer, you are on a very solid wicket. That doesn't mean the job is done. You have to be at it because there will be people trying to displace you, etc. But the first mover on the positioning front has maximum leverage because it takes a while for someone else to dislodge you from that place. Likewise, in terms of more scaled up brands, if you take Greek yogurt, Epigamia automatically comes to mind. They own that positioning. Similarly, Veeba for sauces, raw pressery for cold pressed juices. The first guy that gets there has an amazing leverage. It takes a lot to dislodge. The brand has to make something fundamentally wrong, or there are other ways you can attack these guys. But just the first guy that lands that positioning really well in the minds of the customer has the most leverage.
So you also mentioned something earlier, Hari, which was interesting from an investor standpoint. I think this is invaluable to help entrepreneurs understand when might be the right time to take institutional capital, right? Because like you said, sometimes there are dynamics on the investor side, the pressures on an investor themselves, which might lead, I'm not suggesting this is the case for DSGCP, right? I'm saying in general, in the investment landscape, when an entrepreneur takes capital from institutional venture capital firms, there's a pressure on them perhaps to spend cash, run experiments faster and faster, try and scale as fast as possible, right? So could you explain just why that is in general, without a reference to DSG? I'm not talking about DSG. What are the pressures on an investor, a venture capital investor, that cause them to then exert pressures on an entrepreneur to spend money faster or to scale faster?
Got it. So, I think the underlying, the core, where it all stems from is just that as investors, we have a fiduciary responsibility, and, there is a return that we have to make at the fund level. And that sort of translates into, what sort of outcomes every investment should deliver, so on and so forth. So, and you would find investors with preferences across the spectrum, right? As I mentioned, we are probably at one extreme where we say growth is, reasonable growth is fine, but it's more about fundamentals and we're super patient. There will be others who would like you to grow much faster, say 3-4x year on year, continuously, etc. And I should add to that earlier point on return being one of the drivers. The other driver is just the size of the funds itself for investors. Like, there's a reason why DSG is a small fund, because, as I said, we believe that in consumer, it takes time to build. And the moment your fund size increases, it just means that the return expectations also is that much higher. If you are managing a 300 million fund, then you would at least expect every investment to have a material outcome, and that again has a cascading effect in terms of growth expectations and what sort of scale the startup should achieve, etc. So for us, again, given we're CPG focused, we sort of are, I believe, quite well mapped to the depth of the market and the sort of outcomes that consumer entrepreneurs can drive to, as I said, with very reasonable growth trajectories, etc. So, I think that is the main reason, the fund size and, return expectations that build the pressure up. But, I think it's finally raising money from institutional investors is a really long-term journey, especially in the early rounds. When we invest in companies, we take an 8 to 10 year view. So you're literally, agreeing to partner with, one of us at DSG, every month, meeting once in 2 weeks in the early stages, and then monthly meetings, etc., for a good 8 to 10 years. So, you should definitely look at what they bring to the table beyond capital and how you get along with them, the chemistry, all of that. So it's finally, and there are CPG entrepreneurs that are still quite aggressive in terms of the outcome and growth rates that they want to pursue. So they might find a better fit with with an investment firm that's a lot more aggressive, which is absolutely fine. But it's important that they sort of test out the investors and understand and see how the chemistry is like beyond just the capital, the valuation, etc.
So Hari, that's 8 years, monthly call, plus let's say the first 6 months is like twice a month. That's like 102 calls, plus maybe board meetings if you're on the board, plus maybe crisis meetings. So we're talking about hundreds of hours that these entrepreneurs are spending with you, right? So there's a lot that you've seen in terms of their kind of weathering their journey. You said that building a brand is for the long term. So could you talk about entrepreneurs in India, especially because in the alternative protein space, we haven't even yet attained category market fit, right? We're not talking about product market fit on an individual level. The category itself is still finding its feet. So entrepreneurs are understandably thinking very short term. How am I going to figure out my pilot scale and just get to market, think through the first few months and run my experiments, see what's up. But could you give some clues about the kinds of things that entrepreneurs have to weather or brands have to weather in the medium to long term?
You mean, especially in a category like alternative protein where the category market fit itself is not established?
I mean, actually, maybe perhaps as other categories have been more established, you've seen brands grow and stick around in the market for longer, right? So like, let's say a raw Pressery or a, I don't know how old your investment in Sleepy Owl is, but like those kinds of companies where you've seen those categories grow over time. Those companies grow, they have different challenges at different stages. The brand faces different, sometimes it's crises, temporary crises, you have to weather them, move forward. So what kinds of things have you seen?
Right. So, especially in, I would sort of bucket this in this, new category creation play where, we know that long term, the opportunity is tangible, but it's anybody's guess in terms of how fast the segment will open up. So, in that kind of situation, what has worked well, again, from our experience, is where you sort of identify, again, it's the same principles 101 in terms of who your early adopters can be from a need standpoint, and then what is the pain point that you're solving, and trying to establish really solid levels of stickiness, brand love, etc., with just that segment, right? And then you tailor the business model such that you can get to profitability if you want to, if the market doesn't open up rapidly enough. Do not forward invest way too much just betting on the market opening up, because the fact is it is anybody's guess. So it is better that you sort of align your investments, bets in tandem with what you're seeing on the ground, people coming on board, just the growth rates you're seeing. So it's sort of a balance. And if anything, I would just, again, it goes back to not being unrealistic in terms of growth rates and, betting on the market opening up, because honestly, it's a 50-50. It's anybody's guess. So what you can do is you have a very good understanding of your early adopters. So see how well you can service them a lot better, and then tailor the business model in such a fashion that, you can be self-sustaining till you get to that inflection point, right? So if anything, that is a playbook that that is worked out for some of our brands. And then Sleepy Owl is sort of in the in the same is, I don't think, any longer, but there was always question marks around how big the cold brew coffee segment would open up in the country. But if you look at it, they built a fantastic brand. They are currently only in 2 markets, Delhi and Bombay, and that's by design, because we know that it's a fairly niche segment that they're catering to. And the brand love, customer stickiness, etc., is phenomenal. So what they have done is, we understand that this market may take some time to open up, but they've also launched new products like, the hot brew bag, which actually is a massive step up from instant coffee that, consumers are used to. And that product is seeing very good traction. And with respect to cold brew, now we're working on, a use case where we're finding that our customers sort of treat it like an energy drink as well. So, again, just working on positioning to cater to that need state of the consumers also, and see how fast that'll open up the market, right? As opposed to just being seen as an exotic coffee product. But again, I think just zooming out, it's about building customer love and tailoring the business model to, just allow you to wait it out as the market opens up.
Yeah, this is great, Hari. I mean, there's a lot that you're saying that's kind of these nuggets of wisdom that we see play out in our space as well. And it makes sense. Look, you guys have done investments in companies that are creating categories, right? Epigamia has been creating the Greek yogurt category. Obviously, dahi is a staple, but the Greek yogurt category. And then raw with, I mean, I think especially if there are food technologists in the crowd, I know, Shardul, you'll agree with me. You've studied high pressure processing, cold pressed juices, etc. in college, right? And that's something that raw really created as a market consideration in India. Similarly, Sleepy Owl, like you're saying. Hari, the question, the point that you made right at the beginning is, early adopters and brand love, just basically being able to size all of that and hone in on that, make sure that that exists, because that's not going to leave you even in a, if the category doesn't open up in a huge way, you'll still have the early adopters and the people that have serious love for your brand, right? Even if you're not able to say, okay, this is opening up in a huge way, suddenly I'm able to just pour gasoline on this and it's going to take off with the rest of the population. At least you have your very loyal customers that are ordering, reordering multiple times a week. That's really the dream as a CPG company, which
Absolutely.
is what we're seeing that in our space as well, that cohort exists, right? It's your urban, upwardly mobile, usually double income, no kids, disposable income type folks who are thinking in terms of flexitarianism, thinking in terms of eating for the planet. They might care about antimicrobial resistance. They might care about obviously COVID and all the news about that and all of that stuff, right? So I think that exists. I think it's up to entrepreneurs to be able to tap into it, I guess.
So in addition, the only other thing, which is really important is tailoring your business model also. As I said, we focus on brand fundamentals, which is what, you just covered. The other thing is business fundamentals where, you're tailoring the business in such a manner that you can self-sustain and not always need investor money. Because, there are funds like ours that are super patient, but for a lot of investors, they like coming in around that inflection point when you can really scale. So, without getting there, it's premature to assume that you will raise capital, and hence, you'll have to tailor the business model to have really solid fundamental metrics like cash flows, etc. Ideally, you should be in a position to self-sustain if it comes to that.
So actually, that's a really nice segue, Hari, into the next portion. So we've talked a lot about brand fundamentals, and I think you guys are very well placed to talk about that. Let's talk further about kind of business strategy, channel strategy. All of these things matter a lot for food and consumer packaged goods in general. We've seen the COVID-19 pandemic has pushed some channels like food service, restaurants, etc., to the brink, right?
Yeah.
It's driven, on the other hand, significant growth in other channels like home delivery for both fresh and packaged foods, direct to consumer, people shopping online, demographics that were not shopping online before getting more and more comfortable with shopping online, or maybe asking their kids to order them stuff online, that kind of stuff. So as an investor, what would you advise entrepreneurs to think about when they're determining their mix of channels and that piece of the business model? And how do they retain the most control in the face of these major external challenges that could change everything in an instant?
Right. So, in terms of channel strategy, again, I think it's a function of the category and customer segment you're going after. So, you just have to be present in the channels where customers are buying, the alternatives in the market. So, I think it just comes down to that, and typically it's better if again, stepping back, it's all about focus. So when it comes to channels, it's ideal if you can just focus on one channel and test it out before opening up multiple fronts. It just helps because just in terms of bandwidth and doing complete justice to that specific channel, right? As opposed to just launching on multiple channels and trying to balance the act across multiple channels. Invariably, there will be channels that don't get the attention that they deserve. So the question is then, which is the first channel that you have to focus on from get-go? And I think it's just a function of category and and where the customers are purchasing the product, and I mean alternatives, right? Before this brand existed. But given the current COVID environment, as a lot of our brands that did not pay any attention to DTC, etc. before, have been forced to launch their DTC website, including Epigamia, and just the traction that they've seen over the last few months has caught everyone off guard. So much that we've sort of revised our future projections and the contribution of the online channel, just given what what we've seen after the DTC launch. So I think in general, it is better to start where the customer is. But given the COVID environment, I think online is the place to start. And then the question is whether you want to just focus on your own website, or since it's largely a packaged food audience here, or a marketplace like Big Basket, etc. So our suggestion would be to, in online, you can start with your own website and big basket, and then, figure out which channel is getting you better traction in a capital efficient way, etc. And, and then once you hit a certain milestone and you're convinced about traction online, then, open up multiple fronts, Amazon and, Swiggy or any of the other channels. But it's very, it's hard to generalize. It's very category specific, and you just have to go where the customer is.
By the way, I think you have to combine this advice with what you said earlier also, which is it takes time. I think people in our space, especially entrepreneurs who tend to be idealistic, tend to be mission focused, right? They care, entrepreneurs in our space for a very large part care about sustainability. They care about animal welfare in many cases. They care about all of these problems, right? And they see the success of like an Impossible Foods or a Beyond Meat globally, and they think, I'm going to launch my plant-based meat product in Delhi and it's going to go gangbusters, and immediately I'm going to be able to scale across the country. I think having a plan that accounts for the fact that for the first few months, maybe even the entire year, 18 months, 2 years, 3 years, you're going to get a few orders a day, and you're going to have to be very systematic in the way you build it up, not just completely widen the funnel, pump a ton of marketing rupees into it immediately as soon as you start. I think it takes time to build that and run your experiments cheaply. There are questions coming in, for example, about how to make the business self-sustaining. Any insights on the same? I mean, I'll put that question to you, Hariharan, also, but my answer to that is make the business self-sustaining. The best insight here is, the obvious one, which is cost basis versus what's going out of the business. Don't make it unsustainable on day one. That's the best way to make it self-sustaining. Do you have any insights there additionally?
No, absolutely. I think, it's all about focus. And, as you also said, that's a very important point. It's the constant pull that a lot of our entrepreneurs that have a presence in the offline channel face, which is that, they'll have distributors reaching out from other parts of the country saying, there is a lot of demand. Why don't you open up, why don't you start shipping products here, etc. But we just urge our founders to just focus on, in the offline channel, for instance, 1 city, 2 cities maximum, and then get the playbook right. Just nail down the playbook before, you can even think about opening up more cities. Because otherwise, you wouldn't have even arrived at an optimized playbook, and you would have already spread thin, opened up multiple fronts. And that just comes back to bite you, both in terms of just capital efficiency. A lot of capital will be drained in the process. And second, just bandwidth. Your focus is going to be diluted across so many markets, and customer behavior again is very different. So yeah, it's all about focus. And as you said, it's simple. Just pay close attention to your cash inflows, outflows, and just manage costs so that if required, you can just stay bootstrapped till you hit the inflection point.
Yeah, it's also interesting. You said it's much better to be in the position that Epigamia was in when they launched the plant-based yogurt product a few months ago, where they actually ran out nearly immediately, and there was a lack of supply for a week or two, a couple of weeks, more than that even.
No, we didn't expect the demand at all. Yeah.
Much better to be in that position than the alternative, right? Way better to be in that position, because it creates that clear buzz around the product, but also you haven't wasted a ton of cash running the experiment, right? So, obviously business is hard in general. I don't think anything can be perfect, but it's much better to be in that position than the alternative. One great question that's come in that is very similar to this is, oftentimes entrepreneurs have to make decisions and investors have to make decisions on the basis of these market sizing exercises. So given that this area is very nascent and you're an investor, you're used to seeing this total addressable market on every entrepreneur's slides, these numbers can be sometimes hard to believe. So what kinds of sizing discipline, what kinds of sizing thinking are you looking to see from entrepreneurs that zooms in more accurately on their target consumer? What tips do you have on sizing the market?
Right. So, first I must say that as a firm, we do not obsess so much about the addressable market, because as I said, given that's the reason we have a small fund, because it just gives us the flexibility to even, support entrepreneurs that may not build a business that, that's a unicorn, etc., for instance, right? So as a result, we base our decisions primarily on, just whether you're solving a really important pain point for a customer, and whether we see the possibility of building an iconic brand, right? More in terms of just brand love, etc. But the fact is, it's a question that founders will face down the line if they have to raise from larger funds, etc., which have compulsions around this. Broadly, there are two approaches that help. One is what I call fundamentals based. So, like for instance, just to give you an example, if you are a brand that sells in offline stores, and and if you follow this approach of being narrow and deep and just in few markets initially, so the ideal preference is where you take the business to a point where the store throughput, which is essentially the rate of sale of the product in a store, is a healthy number. Just for argument's sake, if you're in 200 stores in Delhi and you're able to get to a rate of sale of 3,000 rupees per store, that's like in general a good place to be in. Then what happens is, when you have to plot out the addressable market, what you achieve by being focused is you've spent all your energies just to maximize the store throughput. And then when you go to an investor and say, hey, I'm in 200 stores, this is my store throughput, tomorrow I can be in 15,000 stores, and that's your, that's the scale that I can achieve, is a far stronger proposition to be in, as opposed to being in 5,000 stores and at a 500 rupee store throughput, right? Then you're not helping. So that is one approach, by being focused. This is for the offline channel. Similarly, in the online channel, you have your typical cohorts. What does the 12-month stickiness look like? So these are fundamental metrics. So you can really use these fundamental metrics to scope out what the addressable market can be. And those really resonate well with investors. The second approach is, especially in new category builders, is to see surrogates. So again, to just give it, bring it live. Like for instance, Sleepy Owl, a surrogate for Sleepy Owl is Red Bull, which is an energy drink. Serves while the consumption occasion can be a bit different because it can be used as a mixer as well. But you can obviously apply a discount factor for that. But fundamentally, if you take the energy drink use case, it is an alternative for consumers. It's at a similar price point. And then you can talk about what Red Bull numbers are, and then discount, say 1 in 2 Red Bulls is for a mixer use case, the others for energy drink use case, and say that, Sleepy Owl can be at least half of what Red Bull is 5-6 years down the line. So, it's important to identify these surrogates more from a customer standpoint. What are the other alternatives that the customer is using today? And, ideally in a similar price point, this is another way to scope out the addressable market. To me, I think, these two are the most convincing approaches that I've seen, especially when you're building a new category.
Yeah, and that's something that entrepreneurs ask us all the time, right? Like, what is the market size for plant-based? And we can do this kind of back of envelope thing. Like, look, this is what meat looks like. This is how many people consume meat. We can do that kind of top down, keep narrowing down.
Yeah, top down, it all looks rosy always.
Yeah. This is 1 billion of these in the country. Therefore, your app's going to sell 1 to 1 billion people. Fantastic. That's obviously not how it works. But okay, so I'm going to ask my last question now and then go to some further questions from the audience, Hari. And this is a very, very interesting one, a doozy, if I say so. Logistics. So India is very difficult to figure out from a logistics standpoint, right? The supply chain logistics and distribution, of course. So particularly with chilled or frozen products. And we've seen, you have this obviously with limited shelf life products at raw as well as Epigamia. So raw has a slightly higher shelf life, but you get what I'm saying. So most entrepreneurs struggle or will struggle to secure distribution and supply chain for this reason. And no matter what we say and what you're saying on this call, Pressery and Epigamia have had to spend a serious amount of money to figure out that piece of it, right? So what lessons have you learned along the way from working with those companies, and what would you advise entrepreneurs when they're thinking about this problem?
No, I think that that continues to be a problem. So, and something that one should be very thoughtful about as they build out the business. I think our learnings essentially is two things. One is, it's really important to, again, I think it comes back to just go market by market and improve the utilization, in the supply chain, so that the unit economics, etc., work out fine, instead of, again, just being too aggressive and opening up multiple fronts. Because if your supply chain is running at a suboptimal utilization, you would be bleeding a lot of money. So it's important to factor in the utilization of the supply chain also, and the best way to do that is, again, being very narrow and deep. Don't open another market till you have a sufficient level of utilization in the initial markets, unless you've been able to raise truckloads of money from investors that gives you that cushion to open another market. So I think the first thing is, again, being narrow and deep, and focus on utilization of your supply chain. The second important learning is just demand forecasting, and that is, like, especially in the offline channel, that is a tough one, but something that especially cold chain dependent brands have to focus on from early on. Just in terms, because otherwise, the nature of salespeople is to push the product. It's largely push driven, and there's not much of data, etc., that comes back. So it's fairly high level math when it comes to inventory planning, etc. So being able to forecast your demand as accurately as you can goes a long way in inventory planning, production planning, and hence expiries, etc. So that is something that again will be very crucial when you have these dependencies.
Yeah, that all makes sense. And actually, so even companies that we've helped very early on and continue to help, like a Good Milk in Bangalore, plant-based dairy company, same situation, right? And Shardul will agree with me here that Abhay, the founder of Good Milk, has very clearly said that he wanted to stick in Bangalore for a very long time and figure out logistics. It takes a very long time to figure this stuff out, several years before you buy a reefer truck, before you invest that amount of money. You really need to understand the market locally. Of course, this is India, right? It's not Singapore, or it's not the US. So even though we have 20 million people in our cities, wherein maybe 5% of those people could be your addressable market by income, the value of those 5% of 20 million is not going to be the same as, let's say, a Singapore, because the spending power is not as high, or a San Francisco, because the spending power is not nearly as high as San Francisco. But the insights are roughly the same. You still have to be patient, and you still have to build it out over time before opening all these other channels. And I will say,
patience is the main word.
And Hari, you said, unless you have a truckload of cash, but it's not easy to spend cash well either, right? Like, you have to hire a bunch of people. You have to make sure the strategy is there, they're following through on those things. You have to be a seasoned operator to be able to do that well. It's very rare to be able to do that.
Absolutely. By all means, I just meant that to clarify, when I meant truckloads of cash, I meant if you want to expand into another market before optimizing your utilization levels, you can even think of doing that only when you have adequate margin of safety in terms of capital, because otherwise you run the risk of literally running the business to ground, because it is a cash guzzler, a cold chain dependent business. So you'll just have to have that margin of safety if you want to, expand into other markets before delivering the unit economics in the home market.
Yeah, that's very astutely said, Hari. And just a couple of questions. We have some great questions coming in from the audience, by the way. I guess let me ask you this question because I'd be interested in understanding your take on it. What do you think of public acceptability in the case of plant-based non-dairy beverages in India? Because it's dairy is so deeply ingrained into the public consciousness in India. What do you think about the potential of plant-based dairy beverages in India?
Right. I think, again, long term, it's definitely going to be a big segment, but just anecdotally, based on what we see in Epigamia, they launched their plant-based yogurt, and you mentioned how it got stocked out, etc. And then even with Raw, when they launched their almond milk, and then now Epigamia has also done that. I think, in terms of just market timing, etc., it is starting to open up. But yeah, it's probably still a fairly niche segment, but I think it is at a point where we can get to that inflection point anytime. But among the more evolved and aware segments in the cities, it's already a trend that we're seeing. So Epigamia, the demand for the coconut yogurt is just off the charts, and it just caught all of us by surprise. We at DSG also felt that it's probably still not there, this move towards non-dairy, but I think that it's almost here. So yeah, I think that's our take on that.
And we talk to the folks Siddharth and Rohan and stuff, and people at Epigamia all the time. I'd be interested in understanding also the drivers and occasions for that demand increase. I mean, that high demand for the coconut yogurt. Are people seeing it as a like-for-like replacement? Are they using it in different occasions? How are they using it per se?
No, I think it is a like-for-like replacement in terms of just the occasion of consumption. But I think it's just, in general, people are cutting down on dairy, and my hypothesis is the biggest driver is, and then we're seeing it in some of our supplement brands, right? Nutrition supplement brands. This whole gut health is a massive problem in the country, and people are realizing and are being advised on food products, etc., that they should consume, which can alleviate the symptoms, all of that. And I think at least in the circles, the segments that we are talking about, there is a general attribution of to dairy when it comes to gut related issues for customers. So I think with Epigamia, what's happened is they have a really loyal customer base that's anyway looking to cut down on dairy. And when Epigamia, launched a non-dairy option, they just jumped at it. And again, given that Epigamia is for, these customers are super loyal, they didn't mind that higher price point as well, because this product was at a much higher price point compared to the core range.
Yeah, that's very well said. I think so. There's this like kind of there are these various factors that when you pair them together, it's almost like a superpower for a category or a particular product, let's say. So, for example, in any of these alternative proteins or any alternative product in general that is an alternative to an entrenched product, there are some things about the entrenched product which are non-negotiable. In the case of food, it's taste and price, right? So, like meat. If you're making a plant-based meat product, if you're targeting someone that likes eating meat, obviously, the taste of meat and, ideally being competitive on price with meat, or at least cost basis, so you can compete, then you can position it at whatever price you want, depending on your segment. But the taste of meat and the price ideally should match or be on a path to matching it. And then when you pair it, as in the case of dairy, as you're saying, when you pair it with this additional component of like, there's a health halo around plant-based dairy or anything that's not lactose dairy, you get this set of circumstances that drives the category forward. But I think the non-negotiables can't, obviously by definition, they can't go away, right? So like if Epigamia launched a product that tasted bad, it really wouldn't do well.
Absolutely. Yeah. But I think there's just one of the dimensions where we have a slightly different take on, which is that the common perception is that India is a very price sensitive market. But we've just seen it in all our brands that if you deliver a really compelling product, the customer is willing to pay, and price is not a constraint at all. It's only when you sort of start targeting the more massier segments, maybe that could be at play. But given that even plant-based meat, etc., would initially start off catering to the more evolved segments, there the price inelasticity is really high. So people will pay. If you deliver them a good product, you can shoot for those really good gross margins, and people will pay. Sorry. And then whenever you are attempting to cater to the mass segment, at that time you can potentially launch a sub brand that's more price competitive, etc. But our general view is, in most categories in India, you can build a premium brand at really good pricing and scale up to 100 crores. I think India has gotten to that sort of per capita income where building a 100 crore brand just catering to the premium segment is definitely a possibility.
Okay, now thinking from a mission standpoint, this is my last question, and this is also coming from the audience. Thinking from a mission standpoint, purely a mission standpoint, putting that hat on, in terms of sustainability and public health and all of that stuff, now in order to be able to scale from what you're describing to a much broader base of consumption, the mass market, like you said, what is the playbook for that, right? So initially, a lot of brands will cluster at the top end of the market. What is our playbook as an industry for going from that to being able to target the entire market?
No, I think the playbook is, by the time you get to that 100 crore mark, and and if you've really focused on brand fundamentals, etc., you've just created a really solid brand cachet and an aspirational value, right? By then, even the masses would have known you, and that aspirational positioning will be cemented in their minds. So at that scale, the easiest thing is you can leverage your existing distribution to launch another brand. Again, there are multiple ways to look at it. You could think of launching a completely different brand, and because the last thing you want is launching another product under your mother brand that could just take away the brand equity, etc. If anything, what we've seen is it's better if you launch a brand that that's separate, and then obviously start with your current distribution and scale it up, and then look at distribution beyond that. So maybe if the original brand is just in, say, top 10, 20 cities, just launch the lower priced brand, under a different brand name in your existing distribution setup itself, and then scale that up, and then look at penetrating the other geographic regions in a systematic way. Again, it will be the same playbook. Go market by market and don't get super aggressive and get ahead of yourself. Start with what you know, and then start opening up different fronts in a systematic way.
Yeah, that makes a lot of sense, Hari. Thank you so much. Shardul, did you have any additional questions or thoughts?
Nope, I think this was very helpful. We can take maybe a question from the audience. So in general, Hari, do you think there's innovation coming in the market from any specific alternative proteins, that are indigenous to the Indian market, and how you see that segment growing over the next 5 and 10 years? Just general thoughts about how innovation from, indigenous crops into the alternative protein sector would play out.
Right. I think, to be honest, we've spoken with one or two brands, that are in this segment, but yeah, I don't think we've seen like really very product innovation based companies yet, among the ones that we've met. What we've seen is, like, for instance, we have invested in a plant-based protein brand in Singapore, and even there, the innovation behind the product is from an Israel company that's a subsidiary of this company. So I haven't seen innovation on the product front yet in India, but in terms of just in terms of our long-term view for this segment, we're extremely bullish. As I said, we've already invested in a brand in Singapore, and I think even globally, Southeast Asia is one of the fastest growing markets for this segment. In India, it's still early days. In India, if anything, the shift to non-dairy is something that seems to be already here. But in terms of just plant-based protein, it's a little behind, according to us, when compared to the shift to non-dairy. But yeah, long term we are bullish. So we are definitely looking out for opportunities to invest in this segment.
Thank you, Hari. And what's great is, in line with everything you've been saying, it seems like the drivers of consumption, the latent need or the need state that you mentioned earlier, it exists on the ground in India, and the lag actually might be more on the supply side or the innovation side at this moment, at these margins, than on the demand side, which is really great to note, right? So we're looking for more entrepreneurship, more innovation in this space over the next years. Thank you so much, Hari, for your time here today. Shardul, let me hand over to you, Shardul, to close things out.
Perfect. Thank you so much, Hari, for joining in today. I'm sure that the insights have taken copious notes throughout the session, and I'm going to send it to the community as well. It's definitely going to help a lot of our entrepreneurs who are on the verge of launching products in the market, and I'm sure good relationships will also form going forward with DSG and our community. So once again, thank you so much, and thank you so much everybody who's joined us on this Friday evening. All of you would be getting the recording and the notes of the session as always in our monthly community mailer, which is the kind of mode we have shifted to now for regular communication with the community in a concise format. So if you haven't checked that out, please do. Thanks again.
Great.
Thank you for moderating the session. Bye. Have a great day.
Talk soon. Bye.
Yeah. Bye.